Starting a new business is thrilling. It's a whirlwind of ideas, passion, and the drive to create something truly your own. You're the architect of your dream, ready to build it from the ground up. But amidst all the excitement, one of your first big choices, and a crucial one at that, is how to structure your business legally. This isn't just a formality, it's the foundation upon which your entire enterprise will stand. This decision impacts far more than just paperwork. It directly affects your personal liability, how you'll handle taxes, and your long-term financial health and stability. It's a decision that requires careful consideration and a clear understanding of the implications. In the US, most entrepreneurs, especially when starting out, choose between a sole proprietorship, which is the simplest form, and a limited liability company, or LLC, which offers a layer of protection for your personal assets. Many believe an LLC automatically translates to tax savings, a common misconception that can lead to unexpected financial burdens. But that's not always true, and in many cases, it can be quite the opposite. The tax implications are far more complex than a simple blanket statement. The real differences between these structures are more nuanced and depend heavily on your specific circumstances, your industry, and your long-term business goals, and depend on your unique situation. What works for one business owner might not be the best choice for another. Understanding how each structure works, its advantages and its disadvantages, is the first and most crucial step to making a smart, informed choice that sets you up for success. We'll break down the basics of each structure, explaining them in plain language, compare their tax treatment side by side, highlighting the key differences and potential benefits, and look at real numbers and examples to illustrate how these choices can impact your bottom line. Our goal is to clear up the myths and misconceptions surrounding business structures and help you focus on what truly matters for your business's financial health and your personal bottom line. Whether you're a freelancer working from your laptop or a shop owner managing a bustling retail space, this decision significantly shapes your financial future, influencing your profitability and long-term success. Let's dive in, explore the options, and see which structure fits your business best, empowering you to make a confident and informed decision. A sole proprietorship is the simplest business structure in the US. If you start working for yourself without registering another type of business, you're automatically a sole proprietor. There's no legal separation between you and your business. Profits, losses, and liabilities are all yours. This means your personal assets are at risk if your business faces debts or lawsuits. Setting up is easy. No state paperwork or fees, just start doing business. If you want a business name, you may need to file a DBA. The low cost and simplicity make it popular for freelancers and small business owners. No separate bank account is required, but it's smart for bookkeeping. The trade-off? No personal liability protection. That's the key difference when compared to an LLC. An LLC is a formal business structure, legally separate from its owners, called members. The main draw is liability protection. Your personal assets are generally shielded from business debts and lawsuits. It combines the liability protection of a corporation with the flexibility of a partnership. To form an LLC, you file articles of organization with your state and pay a fee. Most states require a registered agent to receive legal documents. You'll need to keep business and personal finances separate to maintain protection. LLCs must file annual reports and pay ongoing fees. If you mix personal and business funds, you risk losing liability protection. While it's more work and cost than a sole proprietorship, the asset protection is a major upgrade. For serious business owners, an LLC offers peace of mind. For federal taxes, both sole proprietorships and single-member LLCs are pass-through entities. The business doesn't pay income tax, profits and losses go on your personal tax return. You pay income and self-employment taxes on your net profit. Sole proprietors report business income and expenses on Schedule C with their personal tax return. Single-member LLCs, by default, are taxed the same way. No difference in how much tax you pay. Forming an LLC alone doesn't change your tax bill. The real difference comes from the LLC's flexibility. It can choose to be taxed as an S-corporation. This S-corp election can change how you pay yourself and potentially reduce self-employment taxes. Without this election, taxes are identical for both structures. The S-corp option is where real tax savings can start. We'll explore that in detail soon. Do LLCs get more tax deductions than sole proprietorships? No. Both structures can deduct the same business expenses if they're ordinary and necessary. Deductions include supplies, advertising, insurance, travel, and home office costs if you qualify. The key is good record keeping. Save receipts and track expenses. Both file deductions on Schedule C. Deductions lower your taxable profit, reducing both income and self-employment taxes. The real tax savings with an LLC come only if you elect S-Corp status, otherwise deductions are identical. LLCs offer liability protection but come with extra costs and paperwork. There's a state filing fee to start, ranging from $50 to $500 plus depending on your state. Most states require annual or biennial reports and fees to keep your LLC active. You may need to pay for a registered agent service. Maintaining an LLC means strict bookkeeping and a separate business bank account. You might need legal or professional help, adding to costs. Sole proprietorships avoid these expenses and are easier to run. Weigh these ongoing costs against the benefits before deciding. Let's look at a real example. Alex, a freelance designer, earns $50,000 and spends $10,000 on business expenses, leaving $40,000 profit. As a sole proprietor, Alex pays self-employment tax, 15.3%, on about $36,940, totaling roughly $5,652. If Alex forms a single-member LLC but doesn't elect S-Corp status, the tax bill is exactly the same. The LLC gives liability protection but no tax savings by default. Alex still files Schedule C and pays the same self-employment tax. The only difference is the extra state fees for the LLC. This shows forming an LLC alone doesn't save you on taxes. Both structures pay the same self-employment tax on net profit. Tax savings only come if the LLC elects S-Corp status. We'll see how that works next. The real tax advantage of an LLC often isn't immediately apparent. While forming an LLC provides liability protection and a more professional image, the true financial benefits often materialize when the LLC elects S-Corporation status. This election can significantly alter how your business income is taxed, potentially leading to substantial savings. But it's not a one-size-fits-all solution, and understanding the nuances is crucial. With S-Corp status, the owner is considered an employee of their own company, and must pay themselves a reasonable salary, which is subject to payroll taxes, including Social Security and Medicare. The IRS scrutinizes this reasonable salary to prevent owners from avoiding taxes. Any remaining profit, after the salary is paid, can be taken as a distribution, not subject to self-employment tax. This is the key advantage of the S-Corp election. These distributions are treated differently than salary, leading to potential tax savings. Let's revisit Alex's $40,000 profit. This is the total income generated by Alex's business before any deductions for salary or other expenses. If Alex pays a $25,000 salary, recognizing that this amount needs to be justifiable as a reasonable compensation for the work performed, the remaining $15,000 is a distribution, which is not subject to self-employment taxes. This is where the potential tax savings begin to materialize. Payroll tax on $25,000 is about $3,825. This includes both the employer and employee portions of Social Security and Medicare taxes. This is less than the $5,652 self-employment tax Alex would pay as a sole proprietor or single-member LLC without the S-Corp election. That's a savings of $1,827. This represents the difference between the self-employment tax and the payroll tax, showcasing the potential benefit of the S-Corp election. But S-Corp status adds complexity. It's not just about filling out a single form. You must run payroll regularly, file extra tax forms with both the IRS and your state, and possibly hire a payroll service to ensure accurate and timely payroll processing and tax filings. These costs, including accounting fees and payroll service fees, can eat into your savings, potentially negating the tax benefits. S-Corp status usually makes sense when profits are high enough to outweigh the extra hassle and the associated administrative costs. A general rule of thumb is that it becomes worthwhile when profits exceed $40,000, $50,000. If your profits are modest, the savings may not justify the added work and expense of maintaining S-Corp compliance. Always weigh the administrative costs against potential tax savings, considering your specific financial situation and business structure. Consult a tax professional before making the switch to S-Corp status. They can help you determine if it's the right choice for your business and ensure you comply with all applicable regulations. Embarking on the entrepreneurial journey involves numerous crucial decisions right from the start. one of the most fundamental is selecting the appropriate legal structure for your business. Choosing between a sole proprietorship and an LLC depends on a careful evaluation of your risk tolerance, anticipated income, and overall business goals. It's not a one-size-fits-all answer. The best choice is tailored to your specific circumstances and aspirations. If your business is characterized by low risk and modest profits, perhaps a venture like freelance writing or a small online store, a sole proprietorship offers a streamlined, simple, and cost-effective solution. It's easy to set up, with minimal paperwork and straightforward tax reporting. However, if you anticipate facing higher liability, such as in a business involving physical products or professional services, or if you have ambitions to significantly grow your company, an LLC offers crucial personal liability protection and enhanced credibility in the eyes of customers, partners, and investors. It separates your personal assets from your business debts and obligations. The potential tax savings associated with electing S-Corp status for your LLC only become truly advantageous if your business profits are consistently and substantially above $40,000 to $60,000 annually. This is because S-Corp status allows you to pay yourself a salary and take the remaining profits as dividends, potentially reducing your self-employment tax burden. However, below that threshold, the extra administrative costs, accounting fees, and payroll complexities associated with S-Corp status may very well cancel out any potential tax savings, making it not worthwhile. It's often wise to start simple, especially when you're just beginning. You can easily begin as a sole proprietor, focusing on building your business and generating revenue, and then seamlessly switch to an LLC as your business grows, your risk profile changes, and your profits increase. This allows you to adapt your legal structure to your evolving needs. Always prioritize asset protection first and foremost, ensuring your personal assets are shielded from business liabilities. Tax savings are important but should be a secondary consideration. Take a moment to think carefully about your long-term vision for the business. Do you envision it remaining a small, manageable operation? Or do you have aspirations to scale up, expand your team, and reach a wider market? Selecting the right legal structure sets a strong and stable foundation for your business's future success, providing the framework for growth and stability. Ultimately, make your choice based on what best fits your current needs and circumstances today, considering your risk, income, and growth plans. And remember, the business landscape is ever-changing, so remain flexible and adaptable, knowing that you can always adjust your legal structure as your business evolves and grows over time.